Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. We've talked a bit about the different types of property investing in Australia over the last year, but today I wanted to focus on one in particular, the recovery in the commercial sector. Commercial property broadly covers everything from offices and warehouses to shopping centres, even data centres. Some of those thrived during lockdowns, whereas others are just recovering now. There's also lessons investors can learn from overseas markets, which have reopened before us. Damian Diamantopoulos is the head of property research at Australian Unity. Damian, welcome to Fear and Greed.
Great to be here, Sean. Thanks for having me.
Let's start with retailers and shopping centres, something that we're all thinking about at the moment, a few days ahead of Christmas. Some have performed better than others during lockdowns. For example, suburban shopping centres seem to have done pretty well compared to some of those big malls. What's the outlook for them, do you think?
Oh, it's a great question. I think if you break it down, it's really all about essential spend versus non-essential spend retailing. So discretionary versus non-discretionary. So if you break it down, you look at the convenience-based shopping centres, the supermarket-dominated shopping centres where 50 to 80% of the rent roll's dominated by Coles, Woolies or Aldi or a combination of each. They're the types of assets that, as we saw during the pandemic, really came into their own in that everyone has to go to the shops to continue to I guess, feed themselves, to buy their daily essentials, etc. And, they're the ones that remained open throughout the whole pandemic. And then you look at the underlying covenants, Coles, Woolies, Aldi, they're good payers of rent. If you switch to malls as an example, well, with their discretionary element, dominated by fashion and eating in and entertainment, etc., they struggled because, during the pandemic, we did see that they had to close and then readjust their business models. The underlying retailers had to adjust their business models to more of an online offering to cater for the current world that we live in. And we saw it with, valuations. If you look at some of the most recent valuations that have come through on the supermarket-dominated shopping centres, we're seeing property yield compression, which means property values going up. We saw that with Shopping Centres Australia just the other day. They've pre-announced their results, but some of the pain's really been in the bigger mall space. And if you break it down even further with some of those bigger malls, it's really the CBD-dominated malls that have really fared the worst. But again, roll forward, borders open, and they very much become a reopening trade.
Yeah, okay. Damian, if I want to invest in this, so you need to go through a managed fund. It's very difficult for an individual to invest in a shopping centre, for example, or retail outlets. I suppose you can own a strip shop or something like that. How do you work out, though, whether you're investing in CBD shopping areas or whether you're investing in regional shopping centres? Is that a matter of going through the fund itself?
Well, that's right. You've really got to look under the hood and see what the underlying managed fund, whether it's a managed fund that invests in listed property stocks or whether it's a managed fund that invests in direct properties. You really need to look under the hood to see what they're currently owning. And even, retail is different by catchment. You can't tarnish all retail with the same brush. Even in the big mall space, you're going to see some perform better than others. So it's really, retail is beholden to the catchment which it operates in. So that's really what you need to do.
Okay. So let's look into office buildings. There seems to be plenty of office buildings still being built, and notwithstanding your comment about the CBD a moment ago and all these question marks about where work from home goes in 2022, hybrid working, there must still be pretty strong demand for office buildings, though, given how much construction's going on.
Yeah, it's a good point that you raise. We're seeing a bit of development across the board still, but tenants are still after space. The pandemic, what it's done is really delay decision making, but now we've come to a point where a lot of tenants, occupiers of space have to make a call, and really what's driving that is work from home has worked throughout the pandemic. That's true. It's been really about flexibility going forward, and that's what users of space are looking to their landlords for going forward. So new builds will have greater amenity, you will have less touch points and that sort of thing going forward. So they're the sort of the developments that will play out in that space. But, work from home isn't for all businesses either. We've all had to work from home for obvious reasons over the last, year and a half, but you'll see more and more, coming into February 2022, more and more return to work edicts coming from employers. And whether that's 1 day a week or 4 days a week back in the office. I think what you'll see though in the main is for employees to be in the office more than they're at home. So call it 3 days a week, and even with that, there's a requirement for being back in the office. And
Yeah.
if you look at the transactional space, we're seeing office buildings trading. They're trading at or around their current book values, office valuations, and held up throughout the pandemic. It was really the mall space that really bore the brunt of it. So office, I don't think, is dead. The office isn't dead. There will be a return to work, but flexibility will be here to stay, I believe. And
Yeah.
you're seeing it even with leases being struck at the moment, where, as an example, if there's a 10-year lease that a tenant's looking to strike, they're after more flexibility in that, maybe there's a review event at year 5 halfway to either expand or contract. So they're looking for
Yeah.
flexibility on that front. They're also looking at the structure of the lease. So, for example, over a 10-year lease, you pay annual escalations. So whether it's CPI or a fixed amount of, say, 2 to 3%, what we're seeing is tenants going to the landlords to reduce that annual escalation for the first 5 years. So it might only be a 1% escalation for 5 years, but then
Mm-hmm.
catching up on the second half of the lease where it might be 4% per annum or thereabouts, in order to pay the same amount over the whole length of the lease, but essentially you're backloading
Yep.
the rental escalations.
Yeah, I mean, it's a really good point. The idea that, I mean, I totally agree. I think people will move back to the office fairly quickly when they can, but the actual style of building that you work in will have to change somewhat, or has changed already because of COVID, right through from touch points through to amenities, through to whether it's hot desking or not hot desking, all those sorts of things. So they're probably it's probably a different office environment in a way.
Yeah, exactly. That's another great point that you raised. So what we've seen in the past is where employees have really been pushed into small workspaces.
Yeah.
You could almost label them, they're in there like battery hens.
Yep.
What we'll see going forward, though, is more space per person and more collaboration space, more open space. And what that'll have is, again, it goes back to the prior point where even if you've got people coming to the office less, you still have a requirement to offer more space per person going forward. So some of it offsets the other. That's something to be cognizant of. And that's really what's driving things at the moment. Again, this is all playing out in the background.
Yep.
So we'll see where it all settles and lands. But those doomsdayers that think the office is dead because everyone's working from home, or that, everyone's going to be working a couple of days a week from home, hence, there's a 30-40% reduction in office accommodation. I think that's a bit false,
Yep.
because there are all these other offsets that you touched on.
Yep.
That will even things out a little bit.
Stay with me, Damian. We'll be back in a minute. I'm talking to Damian Diamantopoulos, Head of Property Research at Australian Unity. Okay, so let's go on to industrial and logistics. If any property sector has had a good pandemic, so to speak, it's got to be that area because of the huge surge in e-commerce and demand for logistics. Do you think these sorts of returns, which have been really good, can continue? Because it looks pretty pricey.
Yeah, if you talk about winners and losers, the industrial sector has been a clear winner. And if you look at returns, year to September, these are MSCI and PCA numbers.
Yep.
You're looking at a 24% return
Wow.
coming out of industrial for the 12 months. Then the prior 12 months to September, you're looking at around a 12% return. Putting that into context, if we compare it to the laggard being retail, you're looking at a 4-ish% return for September 21, or for the year to September 21, and around a negative 11% return for the year to September 20. So just in those returns, that encapsulates exactly what you've articulated. But really, it's all been, working from home has meant that all the retailers have had to adjust their business models, which has meant that online has come into its own, and it's meant that there's been a greater demand for warehouse logistics and getting the end product to the consumer. So that just means more industrial space required. Hence, if you've been involved or been invested in the industrial sector, you've done well. For many, though, they've been underweight the industrial sector. And when I talk about many, we're talking about institutional investors, we're talking about superannuation funds, we're talking about global pension funds and sovereign wealth funds. They've traditionally always been underweight industrial. It's been seen as the poor cousin out of the big three of office, retail, and industrial. And all of a sudden, the merits of it have come into its own. Most of the underlying tenants in industrial have continued to operate throughout the whole of the pandemic, have continued to pay rent throughout the whole of the pandemic. And then you've got it from the transactional side, where everyone wants to get set if they've been underweight the sector. So you've seen some really strong returns, and you've seen capitalisation rates or property yields really compressed to what we're seeing now for good quality industrial being in the low to mid 3% range, which is quite low and the lowest of all the sectors, remembering that property yields or capitalisation rates, the lower they go, the higher the valuations go. There's an inverse relationship.
Yeah. Okay, one final thing, Damian. I've heard you talk previously about the importance of high quality assets. So whether we're talking about retail or office or industrial and logistics, you're a fan of sort of high quality assets?
I am a fan of high quality assets, but the definition or how one describes high quality can differ across the board.
Yes.
So, my view is it's all about the quality of the underlying income stream. It's the strength of the tenant covenant. You're looking at lease duration, certainty of rental payments. But then at times you've got to look beyond that and also look at maybe higher and better use of the land, whether the property or the land is amenable to development, the catchment that it resides in, the usability of that asset. You need to consider things like obsolescence, which obviously comes into play on the office side that you touched on earlier. So an asset for me doesn't need to be aesthetically pleasing. It doesn't need to be a trophy asset.
Yep.
It just needs to be of a high quality, and that touches on many of the things that I've just described.
Damian, thank you for talking to Fear and Greed.
I appreciate the time. Thank you.
That was Damian Diamantopoulos, Head of Property Research at Australian Unity. This is a Fear and Greed Daily Interview. Join me every morning for the full Fear and Greed podcast with all the business news you need to know. I'm Sean Aylmer. Enjoy your day.